Today we are analyzing Intel Corporation, ticker INTC. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. First up, this company is operating in the semiconductors and semiconductor equipment industry. They have a $145 billion market cap, $167 billion market cap. So we can see about $22 billion in net debt on this business. That's about 15% of the overall enterprise value. Seems to be a reasonable amount. So the Intel Corporation designs, develops, manufactures, markets, and sells computing and related products worldwide. Has various groups, including client computing group, data center, AI, Mobileye, accelerated computer systems and graphics. They're producing a lot of components that go into computers, into various pieces like that. You're talking about the chips, certainly known most for their chips, and that is a big part of their company. Beta 0.88, sure turnover 232%. Now, return on invested capital. The first thing that we can see here is they have 20 straight years of profitability, 22 straight years of profitability all the way back to 2000. That's a very good sign. Anytime you are profitable each and every year, it is a sign of a high quality business. Now, the second thing I notice immediately is that you are cyclical in this business. You can see the cycles very clearly. You're going up and down, cycling like a wave. You go from 3% returns in 2001, 22% in 2005, down to 10%, up to 24%, down to 10%, up to 21%, down to 5%. Now, one of the things that I like here is that a lot of these troughs at the bottom of these cycles, like in 2009, you're still earning a 10% return on invested capital. In 2017, you're still earning a 10% return on invested capital. So even during the low end, you're getting a 10% return on invested capital. That's a very good sign. On the higher end of the cycle, you're getting 22%, 20% plus is a very good top of the cycle. So when you're fluctuating between 10 and 20% versus between like 5 and 10%, it's a much better business model. So you tend to want to avoid cyclical companies, but this would be one of those exceptions where the company is cyclical, but despite those cycles, they're always profitable, and the bottom of the cycles tend to be at still relatively good performance points. Some companies, the top of their cycle, they would hit a 10% return on invested capital, but we're seeing that only in the lows on the cycle. So that's a very good sign. The other thing that's really nice about sometimes investing in a cyclical company like this is that if you know where these cycles are, you could potentially time it very well. You know, if you're able to hit the bottom of a cycle just before it bounces back up, you could get in a very good position for very strong returns. Now, let's go to some of these key statistics. Return on invested capital, 15%, return on equity of 20%. Both these numbers hit, again, my bar for a high quality business. I want the return on invested capital to be above 10%. I want the return on equity to be above 15%. We're meeting both of these marks with an extra 5%. So again, high quality business. I'm liking what I see here. Now, when it comes to valuation, it's going to be a little bit more difficult. You can see this negative PE ratio while having a low price to book, price to sales. It's hard to evaluate based on these statistics of this valuation ratio, probably because they posted some sort of loss in the most recent year. And so we're going to need to assess it with some of the more detailed numbers below. Now, revenue growth, 1.7%. That's pretty low. Asset growth, 8%. One of these things that this will happen is if you're growing your assets that much faster than your revenue, you're going to see declining returns over the course of a decade, and you do see that. 2022, you had a 5% return on invested capital. 2012, 18% return on invested capital. That decline is driven by the fact that they've been growing their assets much faster than their revenue. You're going to get worsening results if you do that over time. You can see the revenue's gone from 52 billion to 63 billion. So again, you're up about 20% over the course of a decade. Not terrible, but you'd like to see more. Unfortunately, despite being higher in revenue, you're actually lower in gross profit, 31.5 billion to 26.8 billion. That's something you want to avoid in a business because what you're seeing is negative operating leverage. Despite growing revenue, your gross profit's actually gotten worse, and your gross profit is really what's going to drive the overall profitability of the business. Operating profit has really gotten punished as well. So you can see that in 2013, you had 12.5 billion in operating profit. You grew that to 22 billion in 2021. So 2021 is actually a good number. You can see that you almost doubled over the course of a decade. That's not a bad result. That's talking about 6-7% type EPS growth over the course of a decade. And yet you cratered your overall results with the 2020 numbers. So 2022 could be just abnormally bad. something to be aware of. But this is worse than a lot of your previous years. You'd have to go all the way back to 2001 to see a year this bad. You can see it fell from 15% return on invested capital down to 5% in a single year. The previous troughs I was just talking about were 10%, 14%, 10%, 13%, and then the last time it got this low was in 2001. So something to be aware of. But again, when I'm talking about cycles, is they could be punished overwhelmingly due to this low result, but we're really not seeing that. I mean, you can see the operating profit here, $2 billion. It's not like the market cap is cratered a ton. So the market is still giving them some sort of understanding that this is a pretty good business with this valuation, because you see these operating profit numbers of 22 billion here. You compare that here, so 22 billion, 145 billion. Okay, maybe we're only trading at like 7 times operating profit if you normalize it over the last 5 years instead of just the 2022 numbers. So that's a little bit more reasonable. You see that if at the what's this? Let's call this upper, maybe $5 EPS, $5 EPS here. Again, 7 times earnings on that number. But if you have to use this $2 number, what is it? $2. 15, 17, so now you're 17 times earnings. Still pretty reasonably priced overall for this company. Nothing alarming here. They're paying a dividend that's grown quite nicely. You haven't doubled in a decade, so maybe you're growing 5 to 6% per share on your dividend from 90 cents to $1.46. And so you need to take that into account as well. You're getting about a 3% dividend yield based upon the numbers I'm seeing here. Overall, pretty good results here. They look a lot better than what you would see on this valuation ratio slide. It seems to be a pretty reasonable valuation for a company like this, but they're certainly not growing very fast. If you're learning something so far, if you're liking this video, hit that like button. Don't forget to subscribe. Let's go to the income statement, balance sheet, and cash flow statement now. So on our income statement, we can take a bigger look here of what's going on. And one of the things you see, of course, when you're talking about this operating leverage is you can just clearly see how they were not able to really cut the cost. Cost of goods sold went up when their revenue went down. That's what's going to cause this cratering effect. Despite lowering gross profit, they still had higher SG&A. They still had higher research and development. So all of your operating costs went up. That's what just destroyed your operating profit numbers. Now, on a trailing 12-month basis, it looks like it's getting even worse. You can see they've lost additional revenue. Cost of goods sold has at least come down a little bit now, but they're still running very high expenses, and so that's what's putting them into a loss on a trailing 12-month basis. One of the things you'd have to do before investing in this company is understand, is this going to be the new norm going forward? Can they return to earning $70 billion plus in revenue, or are now we dropping into the $60 billion, $55 billion range, because those numbers are much worse and their current expense setup can't tolerate it to justify these prices. Now, you have seen that they've been doing some share buybacks. They started the decade about 5.1 billion shares outstanding. They end at 4.1 billion shares outstanding. So you can see they retired about 20% of their shares outstanding over the course of the decade. That's pretty good. You're going to add about 2% per year to your EPS growth rate because of that. It's a good sign. Now, the problem is, if you're not making a profit, you're not going to be able to do buybacks. If you're not making a profit, then the EPS growth is not in existence. So you really need to turn the actual business around. But it certainly looks like this is a company suffering through one of its cyclical troughs. And so you'd want to really consider, can we figure out if this is going to go back up? If it's going to go back up, perhaps this is an interesting time to buy. Balance sheet. A lot of cash, 11 billion, 17 billion short-term investments. How does that compare to our debt? 4 billion in short-term debt, 37 billion in debt. So you can see they have a lot of debt. I mean, you got 28 billion in cash here, 37 billion in debt, 40 billion in debt if you add the short-term debt. So again, a lot of debt. You've gone from 13 billion to 37 billion. You've increased your debt by $24 billion over the course of this decade. And yet your results aren't any better. Your results are actually worse. Your assets have grown significantly. You've gone from 84 billion to 182 billion. So again, that's getting worse. Your PP&E has tripled. No, not tripled. Close, at least more than doubled though. 2.5 times higher. 27 billion to 80 billion. You're continuing to have to invest a lot of money into assets, and you're not seeing the return. Now, can you get the return in the future? Certainly, it's possible. You could see these numbers bounce back up, but so far, we're not seeing the results on the balance sheet. We're not seeing the results in the income statement. All we're seeing is a worsening balance sheet. This is definitely a worsening balance sheet because your assets are growing rapidly and you're having to take on extra debt, you're basically leveraging yourself up. This could work very well if our results bounce back. If they don't, though, you're setting yourself up for a very bleak situation. So it's going to require some macro analysis, or at least micro understanding what their business conditions are going to be in the future, and if this is a cyclical decline or if it's a long-term decline. And that's going to make the difference between whether this is going to be a really big multi-bagger type return or if it's going to end up at loss for you if you were to take an investment. Now, depreciation amortization is really high. So even though you lost money here in trailing 12 months, you're showing a positive cash flow from operations. Now, why is that? Well, a big reason is depreciation is huge. $13 billion a year in depreciation. This makes sense because you're investing massive amounts in PP&E. The problem with a company like this, where you're making a lot of chips, you have to build fabs. So these are fabrication manufacturers, and so they're having to build these big production facilities, investing billions and billions of dollars. I mean, $20 billion invested in a year, $25 billion. The problem is this is a huge chunk of their cash. So that's cash that they can't spend on dividends. It's cash that they can't spend on buybacks. You can see that they were doing a bunch of buybacks up until the last 2 years, and that's really fallen off a cliff, while they've had to accelerate their investments into PP&E. These are huge numbers to put into PPE. And so you're really making a bet on the future. And the problem is this is really how these companies become cyclical, is if you have to make these big plant investments. If everyone does their plant investments at once, then you're going to have these periods where you're oversupplied and periods where you're undersupplied, and it's going to really drive the pricing. It's going to really drive the results. So just something to be aware of there. Not abnormal, it's what I would expect, but you should also expect this depreciation number to continue to increase. It's going to increase towards your overall PP&E spending. If you're spending $20 billion, $25 billion, $14 billion a year in PP&E, then you're going to go up from $13 billion in depreciation. That's going to continue to grow over time. It's going to be a bigger gap between net income and cash flow from operations. Something to be aware of. It is relevant because these are real costs. So I wouldn't use these numbers from cash flow from operations because they're having to reinvest this money. It has to happen. You're clearly seeing there's not a single year here where they're just not making those investments. Those are required investments to maintain their overall business. But overall, I like what I see from Intel. If you specialize in this industry, if you understand semiconductors, it could be a really interesting industry for you to dive into. You can clearly see the benefits of a high quality business here. 15% return on invested capital, 20% return on equity, 22 straight years of profits, all very good. There's also probably a lot of opportunity if you do a deeper analysis on stock price. If you can predict these cycles, if you can understand this industry to know when they're undersupplied and oversupplied, you might be able to get some really nice returns on your investment. For me, the problem is my current investments are already set up where my largest investment is in a semiconductor company, and so I'm not going to be interested in buying another semiconductor company at this time, and that would be a key reason why Intel won't go on my watch list, even though it might be a good fit for other people, depending upon your expertise. This company is much larger than the other ones that I'm interested in, and so that makes it harder for me to predict. They're going to have a bigger influence and impact from the global market than the ones I'm invested in. So hope you learned something. Hope you find this interesting. Hit that like button. Don't forget to subscribe. And if you want to learn how to use this software, I encourage you to check out quickfs.net. My affiliate link is the first link in the description below. A great way to support the channel is to use that link to sign up. You can get a free account or a paid account through that link, and I get a commission when you do so and you sign up through those. I would really encourage you to check it out. I use this software all the time to analyze investments, and I really enjoy it. Thank you for listening, and until next time, stop paying fees, start building wealth.